Okay, so when we get into the section on investing, of course, the biggest thing people talk about and think about in investing is stocks. So, looking ahead in stocks, we're going to have learning objectives. You're on your own for that. But there are common stocks and preferred stocks. We sort of touched on that in the last chapter. Um, and so, we're going to look at the advantages of both and why you might want to get both or why you might just want to be in common stocks. Something to think about too is if a company has increased sales, is that a healthy sign for a corporation? Well, yeah, it is. If they're meeting their budget, if they're making profits, if they're doing things, that's a good sign. It's not all to look for. In my book, you'd have to really kind of do a deep dive to make sure that, because some companies will start off with a loss, um, and then they'll build back. But you have to make sure that the momentum is there for them to build back. You have to make sure that the product they're selling is there, that people want it, because everyone's really great at sales, and they'll tell you, well, yeah, this is just a downturn on the economy, and we'll be back. And some do, and as you know, some don't. So just keep in mind that you might have to look a little further if they're not showing a profit. Why would you want to invest in them, kind of thing? Um, One of the things you want to look for is also be sure their after-tax income increases over time. Again, that's not a set in stone thing that you have to do, but ideally, they should be making a profit and their after tax income should increase. It shouldn't just be the boss making billions of dollars. It should be everyone in the company doing well and surviving well. There are things to look at for those things. So you have to kind of keep in mind you're becoming an investor in that company. So that's the thing to think of. I think sometimes with stocks, they're just kind of a name out there and you don't think about those things. I was trained a billion years ago on, investing, and I believe I've mentioned this before, investigating the company, investigating their price earnings ratio, investigating their history of price earnings ratio, investigating their payouts, their dividends. Are they consistent? Is it a set percent? Are they meeting all these? Have they met them for 10 years? Have they met them for 20 years? And then I always look at it, and we'll get into that too. What do they do in down years? Because there's always a down day or a down year or a down quarter. How have they fared? Have they gone down too, but not as bad? Or have they bottomed out and then they come back? So those are things to kind of keep in mind because, again, you're buying a piece of that company. When you buy a stock, that's what you're doing. So if that company goes belly up and you've got a piece of it, you're going belly up. So just keep in mind you're not just trading stocks, you're actually buying into a company. So you want to make sure you're buying a good company. I mean, in my book, you do. Common stock is the most basic thing that is done. That's the thing we think of. It's the stock you buy on the stock market. You buy it today, you sell it tomorrow, you buy it this afternoon, you sell it in the morning. You have the flexibility to buy and sell at will. And so that's what we think of when we think of common stock. What they're doing when you buy that stock and you're investing in that company, you're giving that company your money. They're taking your money and either investing it, um, finding a new project to build, putting it into their current projects. They're using it for that. And so, they're wanting you to buy their stock. They're wanting you to invest in their company because that gives them cash. It's equity. You're buying into them and giving them that equity to do stuff. Um, in the olden days, way back when, um, there actually was a paper share of stock that you received in the mail when you bought into a company. You didn't have online trading, so to speak, as we do now. You'd have to go to a brokerage house or the company that you wanted to buy stock in, and you'd have to tell them, I want to buy your stock. And the only reason I'm telling you this is just so you understand the premises of it, and even though it's morphed, it's still the same process. And so then you would receive in the mail a paper. It was on really good quality paper too, a paper share, and it could be they might sell their shares in bulks of 10. They might sell them individually. They might share them in 100 whatever on a piece of paper. But you would receive a piece of paper that said you now had 10 stocks, 5 stocks. If they only sold them in one share, each share thing you'd receive 5 pieces of paper. And then it just says you are now a stockholder. And it would say on there what your responsibilities were as a stockholder. You were going to share in dividends, you were responsible for expenses. Now, you personally didn't pay them, but your investment was helping them meet expenses, etc. And then you could always sell that share. Now, in the olden days, you could sell that to someone on the street or your neighbor. If you told them I had some stock, I wanted to sell it, you wouldn't necessarily have to go through brokerage house. It just had to be re-registered. And so you could re-register with the company. It's kind of like a car title. You had the back, and you'd sign on the back, and then you'd tell them I'm transferring my ownership to XYZ. You then gave up your ownership, and that went to XYZ, who had that. Today, of course, that's not the case. You do all that online, and like I said, I think we've kind of gotten away from understanding that you are buying into that company, and actually, you are a shareholder. Um, Dividends, they're not mandatory. If you're looking for something to help give you income besides the growth of the stock, you look for dividend paying companies. There are companies that pay dividends on regular amounts, regular quarters, regular whatever. And then they have in there, dividends are usually paid out of profits. They usually determined by the board of directors. So there may be years that they don't pay them, but typically most companies that pay them, electric companies are very consistent with those kind of stocks. Any of your utility companies are pretty. Now, I'll also tell you, utility companies and banks didn't used to be. Banks are a little more volatile now, but those kind of stocks were usually dividend paying stocks. They didn't fluctuate a whole lot. They would go up, but they weren't this up and down and up and down. So you could buy those for kind of your stability stocks. Know you were going to get a dividend. You could have your dividends pay you in cash. You could have them reinvest and buy shares. You could have them stay with the company and cash it out later. There were some options that you had with dividends. And so, it's like I said, it's a way they share their earnings with you, the stockholders. You also have voting rights because you own stock. You have voting rights. Now, they'll have what they call a declaration date on these things. And they'll say, if you're a stockholder by X date, then you share in the dividends and you get to vote. It's not just you can buy today and vote tomorrow, because you're mad at them or whatever. You have to you have to be an owner by a certain date. Usually it's a month out, 2 months out, so there's a little wiggle room there. And sometimes they'll announce they're declaring their dividends. They won't tell you what they are, but they'll kind of push the market a little bit by saying, we're going to declare dividends if you're an account holder by August 15th. So that kind of makes some people think, oh, I want to get that dividends. I wonder how they are. Let me see if they are. I want to do it. And then you might buy that stock between now and August 15th so that as of August 15th, you hold that stock. Now, if you should sell that stock on August 16th or 17th, you are a shareholder on the 15th, so you would share on that, unless they have it in writing that you don't. Sometimes they say you have to be a stockholder on X date and still hold the stock on X date. So just know that those parameters are out there. But like I said, you get to vote. They'll send out a proxy every year. You can go to a stockholders meeting if you want. As you know, Walmart people love to come to the Walmart stockholders meetings. Most of them are pretty boring, I can tell you. Walmart's got a niche in that for sure. They are not. So, if you have Walmart stock, it might be worth going sometime and take advantage of it. It is an exciting thing to do. But most stockholder meetings are held in big arenas. It's kind of like your big lecture classes here at the university. And they're going over the corporate this last year made $5 billion, and of that $5 billion we'll be sharing with. So they just kind of share that. Now, Apple, I think, has pretty good stockholder meetings because they usually bring out a new product. Sometimes that's rolled out, so they can make it exciting. They've kind of worked on a lot of those kind of companies, especially tech, to showcase their new issues. So if you're in a tech stock, you might want to go to a stockholders meeting, but they're closed to the public overall. You have to be a stockholder to go. All the stuff they discuss there gets, of course, released, but you are a stockholder and you're part of that inside circle. So just keep that in mind when you're looking at buying stocks. They also have, and we talked about this before, preferred stocks. Now, if you're a preferred stockholder, those don't trade like we think of trading stocks. You still are a stockholder. You'll get paid dividends before anybody else. Sometimes in lean years, preferred stockholders get dividends and the rest of the stockholders do not. The preferred stocks, the quote unquote downside is just that you can't trade them. Like if you bought Walmart stock, and I don't know if Walmart has preferred stocks, so this is just an example. But with Walmart, you can log on your little brokerage account, buy Walmart today, sell Walmart next week, whatever you wanted to do. Just, get it on a run. With preferred stock, there has to be another preferred buyer out there, so you can't just sell them. And so you have to be sure when you buy preferred stock, if you get into preferred stock, that you understand it's kind of keeping it for the long haul, and you don't want to just dump it frequently because you can't. You have to have now. Some stocks may have preferred stocks, and buyers are out there all the time. Typically, they've got to have another preferred stockholder to buy exactly your shares and take that on. So that's where it can come into being a little less that. Like I said, you get preferred pluses by having it. It's kind of like having the frequent flyers club when you fly or whatever. You get some preferred things, but it does come with some restrictions also. Again, you will know the dividend before the stock is purchased. You'll get it before it's paid. And a lot of times dividends are set in their parameters. We're going to pay a dividend of X every year, no matter what. Some companies are out there that do that. Railroads used to be phenomenal for doing that. I don't know how they stand now. I haven't done investigating on railroad stocks in quite a while. Um, Okay, so when you purchase common stocks, there's a psychology that goes into it. So now we're going to get into your psych class. Um, but there is a psychology of it. A lot of times we go into it because we all want to have a huge return. So we want to buy low, we want to sell high. That's part of one psychology. And we sometimes forget that there's a risk. We sometimes forget that there can be a loss. We sometimes forget that that company could go belly up. You just think of, I want to get that dividend, that growth. And the bad part about that sometimes is when a stock is really growing. If it's like when these tech companies started off, they would start off at $5 a share, and within a month they were at excuse me, $25 a share, and people are like, "Oh, they could head over hand money." Well, then you buy in at that point. Well, you're buying in at the $25 a share, not the five. So you're starting in at a higher point anyway. So you have to be sure when you're chasing the bubble, you're not getting in after the bubble. If you get in the middle of the bubble, you can still catch some more going up. If you get in after the bubble or on the way down, you're going to miss all that growth that everyone was telling you about. So you have to understand that there's a risk and a reward there, and there's a potential for losses. And sometimes, believe it or not, that part is forgotten because nobody hears the negatives of the stock market. And so they only hear the positives, and it went up today, and yeah, it closed down, but your stocks went up and you're fine and don't worry about it. You don't have to be a jump in, jump out kind of person and worry about it, but just know that they all go up, they all go down, and just when you need that cash, is it up or is it down? And of course, we want to make the biggest gain we can. Then we're taxed on it, but you want to make the biggest gain you can. You want to have it go up. That is our ultimate goal. So and then a lot of times, instead of looking at the in and out that so many people do today, a lot of financial experts will tell you buy it and hold it. Don't get into this in and out. If you believe in the company and you think it's a strong company, keep it because you're going to ride it whatever. Now there are people out there that would tell you, and this was what I was taught way back when I had investments. If you invest $100 in the stock market in a company and it goes to $200, take that $100 out, keep your investment at $100 and gain and claim that profit. And that way, it's kind of like they tell you to do that when you go gambling. When you double your money or you make some money on it, take out your profit and leave your original investment. That way, you've never lost. You've always had some gain, but you've been able to take that gain because with stocks and with gambling, if you go in at $100, it goes to 200, and you think, "Oh, I'm going to let it ride," and then the stock drops the next day to 50. You've not only lost your 100 gain, you've lost 50 that you originally put in. So if you'd taken your profit out and left your original investment, you would have only lost 50 and still made 100. So you would have been net 50 difference. So you can make whatever philosophy you want. Like I said, that's the philosophy I was taught on. That doesn't mean it's right. That doesn't mean it's anything. It's just a way to approach it so that you can always be sure you're taking in the gains. Because, as my husband will tell you, every time in the news when they start saying your 401k lost money or your 401k made money, I always say it's only on paper at this point. It only makes money if you cash it out. The gains are only on paper unless you cash them out. So just keep that in mind when you're thinking about investing and doing stuff. Yeah, my portfolio is worth $5 million. Well, it is only if you cashed it in. If it's not, yeah, it's worth that on paper, but if tomorrow the market plummets, it's not worth that. So, you just have to keep that in mind. I'm Debbie Downer and things like that, I guess. I'm just always like going, well, that's just on paper. I think you need to really think about that. You need to cash that in to take that profit. It's not really a profit yet if you haven't cashed it in. So, but it's just that thing of, I like hype. I like sales pitches. I just don't want people to be snowballed and bamboozled. I don't want them, to think that if they too buy that stock, they'll make $1 million. There's things to think about in that process. So, also, the thing to think about, if you hold things for long term, your taxation's better. When we went through the tax chapter, remember we talked about short term gains and long term gains. Short term gains are if you're in and out in a year. So if you're buying today, selling tomorrow, buying today, selling tomorrow, buying today, selling tomorrow, you're going to have more taxes on your gains because they're all short term. If you hold it for a year or more, then you're taxed at a lower tax rate. So just keep that in mind too when you're looking at investing. Some of it you'll want to do in and out, some of it you won't, but keep in mind what your taxes would be. Of course, always, I'm going to tell you, look at each investment. This is a finance class, and that's my job. I know some of you will let this go in one ear and out the other, but evaluate. Look at the company. Like I said, I really like to look at what they've done the last 10 years, not just today or not just in the 5 months that people have told me about how great the stock is. Look at their product line. What are they doing? Do they have new stuff? Do they have stuff coming out? Do they have stuff ahead of you? Are they always growing? Is it something new all the time? Analyze their finances. It's like looking at your growth and stuff. You want to be sure. Sorry, I got sidetracked. The dog came in. Um, you always want to be sure. I mean, like you look at your bank statement. Somebody's going to look at your bank statement. You check out a financial institution before you go into it. Do the same with your stocks. Make sure that they're sturdy, steady, and are going to be there when you need them. That's the big thing. Monitor their economic development, keep up with that. Again, if they've just got one product and it's weathering the test of time, you're fine. If they're not innovating or thinking of things behind, maybe keep that in mind too. They may be fine in weather continuing into the future, but they may lag behind somebody else who comes up with a new thing. So see what they're doing. And of course, with our economy, you have to keep in mind there's a lot of factors. There's a lot of people in the stock market now that um, I would call them nervous Nelly. And the minute there's a blip, they all jump in and sell. Um, so there's some emotional baggage, is the best way to put it, in the stock market now that you kind of have to think about. So you can look at our economy, you can look at economic development, you can see that where the economy is heading, you can know what's out there, you can make your own decisions. Keep that separate from what you're witnessing day to day. Now, don't be oblivious to day to day because there may be something that's happening day to day that affects that. But if you're keeping up really well and know what's going on, you're going to be fine. And of course, always be patient. Yeah, it may fall today. My my brother, who I don't know that he's ever had anything in the stock market, but anyway, he's just real matter of fact. I'm the real emotional up and down one, which may be real surprising. But anyway, he's just real level all the time. And clients would come in and say, "Oh my, stock market fell today, blah blah blah," and he'd just always go down one day, up the next. And you kind of chuckle at that, but at the same time, that's what it does. So just know you need to be in there for the long haul. Don't get so caught up in the day to day. If the day to day is driving you crazy on what you've invested in because you're petrified you're going to lose it, as I mentioned before, if it makes you nervous, keeps you up at night, that may not be the investment for you. So maybe you need to, next time it pops over what you think is a good price, sell it and then get into something that you're not worried about and watching all the time. We could also look at stocks as being an income maker, not only from the gains, but from the dividends. So you have to be sure that if a company is promising dividends, that they're making enough money to pay those dividends. Um, as I mentioned before, they will tell you a record date. They'll tell you a date. If you're a stockholder on X date, you will receive a dividend. And that's what they call the record date. Then they have what they call an X dividend. And that's where a stock trades without a dividend and the seller is entitled to declare the dividend payment. So that's like if I bought it and had it on the 14th, but then I sold it after that, I'm still going to get the dividend. You're not going to get it if you bought my stock because you weren't a stockholder on the 14th. Or in this case, we're looking at the 24th in this picture. But anyway, that's what that is. So because we're a finance class, the book has an example for you. American Express. They're going to give a 70-cent dividend. Record date is July 5th. So you have to be a stockholder on July 5th. They're going to pay it out on August 9th. So part of that's the psychological part of investing. They declare the dividend makes the news, everybody jumps in and buys the stock. Well, believe it or not, they're not still dividend holders because they didn't have it on the 5th, but that's part of that marketing ploy. So in that case, it gives you the name of the company, the amount of the dividend, the record date, and then if you sell it between July 5th and August 9th, you're still getting the dividend. They're not. And then they're going to pay it on the 9th. So that takes care of that. Typically, you purchase a stock and hold it for a period of time. If the stock increases, you must decide whether you want to sell it. Again, you know my rule of thumb. If you decide to sell, the dollar amount of difference between the purchase price and the selling price represents your profit or your loss. So that's what you look at when you're looking at tax purposes and whether or not you made a gain or a loss in your portfolio. Stock splits. Walmart was the king of stock splits way back in the day. When Sam was alive and they were growing, way more history than you probably want to know at this point, they had a philosophy. If their stock went over $50 a share, he felt that was not affordable for the people in the Northwest Arkansas community to buy it. And it became a strain. So if it hit $50 a share, they would declare a stock split. Now, if it just touched 50 and dropped, they didn't necessarily declare a stock split. If it went 50 for 4 or 5 days, then went to 51, then went to 52, they declared a stock split. What a stock split does is, if you're a stockholder on the day they declare, like the dividends, then you will get double shares when they issue that stock split. So if you have 100 shares and they declare a stock split on July 5th, you will get 100 shares on July 5th to go with your current 100. That makes you have 200 shares. Now, the stock price will drop 9 times out of 10, 10 times out of 10, right after the stock split, because basically they've issued more stock, so it brings that price automatically down. So instead of being $50 a share, the price typically drops just like the shares. It's split, so now it would be trading at 25. And you think, well, that didn't really help me. Well, it does. Instead of having 100 shares at 50, you now have 200 shares at 25. The hope is, and in Walmart's case, was the success, that stock climbs back up. So then tomorrow you're holding, if the stock price goes up to 30, you're now holding 200 shares at $30 a share. So you can see how that helps you. And of course, then if the stock went back up and hit over 50 again, they would have another stock split. So then now you get 200 shares to your 200 shares. Now you have 400 shares. And that is how most of the people that were connected with Walmart made all their money when it started, because that was a very consistent pattern. I worked with people that had money in their IRA accounts at the bank that, I mean, it grew exponentially just from the stock splits alone, and that's what individuals did also. So stock splits are very common, but they're not something, you don't see them quite as consistently as you did with Walmart in that stage. And of course, Walmart trades over $50 a share now anyway. They haven't had a stock split in quite a while. So you just want to, keep in mind what their philosophy is. Now, it could have gone the other way with Walmart. There were a lot of naysayers who didn't think Walmart would be successful because it was kind of like Kmart, but it wasn't as clean and nice a store, and it was local. Kmart was national, blah 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 blah. Well, you can see how that turned out. Kmart's belly up, Walmart's growing exponentially. So, could we foresee that? I don't, probably, but not to the extent that it is. I'll be honest, I don't think a lot of the people way back in the day that were projecting Walmart's growth could get it to where it is today at all. So you just never know. So sometimes buying a local company's worthwhile. My rule of thumb, if you want to get in the stock market, try something, is buy stocks of products that you like or use, because you're more apt to keep up with them. Or buy stocks that that are around us. Like if you're in Northwest Arkansas, you can buy Tyson, Walmart, JB Hunt. And the only reason I say that is it's a little easier to keep up with news articles, to keep up with complaints, to keep up with lawsuits. If you're buying stock that's out of the country or something, you've got to really read a financial page to keep up with what's going on with them. If you buy stock in like L'Oreal, if you're a girl, or in Lululemon, that's the big thing too. It's grown exponentially, um, and you like it. You like the company. You like the clothing. You like the things they stand for. When there's an article, when you're scanning the paper or you're looking at your headlines on your feed or whatever, you're gonna that's gonna catch your eye because you like that company, and especially if you have stock in it. So you're gonna want to see, have they got a new sportswear line? Are they outfitting the people at Wimbledon? Are they, those kind of things that can help you know. So again, if it's a stock you're using or a stock around where you are, people that have bought like Tyson, we will hear sometimes in Northwest Arkansas if there's a disgruntled employee lawsuit for one of the companies around here before it hits national news. So, it just gives you an edge of there could be trouble on the horizon, or it's a good time to buy, or maybe I should sell, those kind of things. So there you go. And then this is just a chart that shows you what I just told you and rambled on about forever about the stock split, how you have double the shares. They're worth less after the split, but you have more shares. So that gives you that opportunity for more growth. There are classifications of stock investments. If you run in a financial circle or you run with a bunch of investors, um, you'll probably hear some of these. If you don't, you may hear them on uh, oh, the CNBC guy that shouts at the TV. He'll use these words a lot of times. But there's a blue chip stock. Those are I think I told you, the big Fortune 500 kind of companies. There's cyclical stocks, and those are stocks that may go follow a cycle. They could be Vikings, since Vikings taking off is the new thing everybody wants to do, bicycle companies. Um, Avocados took off, an investment for farms and stuff, because avocado toast became the thing everybody wanted to have for breakfast. So that's a cyclical thing. Defensive stocks, those are like especially for military defense typically, but they could be stocks that are, just defensive against the market also. So you have to be sure which one you're following there. Growth stocks, of course, that's, they're stocks that you're counting on growing. Income stocks, those are the ones that are going to pay you the dividends all the time. So those are considered income stocks. Now, they may be a blue chip and an income. So they would have two categories for one stock. Large cap, those are big companies. That just means they have large capital. So those are your bigger companies. There's a small cap, a mid cap, and a micro cap. And that has to do with the capital. So small cap is smaller capital, smaller businesses. Mid cap is the mid-range businesses. They have a middle ground of capital. And micro cap are the teeny tiny mom and pop kind of businesses, but that are trading on the stock market. And they have a micro capitalization, capital reporting, but they're growing or spreading or adding stores, or maybe something local that's kind of networking out. But it is trading on the stock market, and of course, there's a lot of stock exchanges. There's not just the New York. We'll get into that too, but there's other options for you to buy, and then value stock, and then penny stock. I've had students in the past that say, "Oh, I just buy penny stocks and I do just fine," and that's great. And basically, what those are what they're saying they're penny stocks. Now, you may not buy them for a penny, but they're really low cost stocks that hopefully are going to increase. And you buy low and sell high. And of course, you can't buy any lower than a penny, which is where it gets its name. But they may be $5 a share, or $2 a share, or $1 a share. And the hope is that they're wanting to build capital, so they're making their stock affordable. So you're buying into it. That's giving them money to develop what they're developing, and then they usually don't stay a penny stock. They become something else. Most corporations have a website. If they do, go to those and see what they're like. I don't know if this will take me there or not. No. Yeah. So here's NVIDIA. Maybe. I'll type it in case. Yeah, NVDA. There. There we go. It's currently trading at 213. As you can see, it's dropping a little bit. This tells you how it's done today. Gives you an idea. It opened at 7 a.m. It is, and then how it's done. Uh, at 11 a.m. So it's really shot up today for some reason. That's a good stock to pick for you, isn't it? This, if you keep scrolling down, will tell you it closed at 207 and it's currently trading at 213. So it while that chart looks like it's really shot up, you can see it's just 213, and it started at 207. It says at 205. So you can see it's having a good day. So, why? Well, you can look over here and see if there's some articles about it. There's recent news? Did something come out that people think, "Ooh, let's get that." So it's worth checking just to see. So if you have stocks, again, I'm not with Yahoo Finance. I'm not trying to promote Yahoo Finance. They just have been very easy to work with in this class setting and for me to track stocks and follow stocks. And you don't have to pay a premium or be a member or anything. You can just, set up your account. There's a plate tab over here to do my portfolio. So if you're watching a bunch of stocks, you can keep up with them. But anyway, so that gives you an idea of doing that. Also, NVIDIA would have a home page that you could go to and read about them, find out about them before you invest in them. So just keep in mind that you want to find out what you're buying, not just buy it on somebody's recommendation. Again, because you're a stockholder. Some people, there are stocks that you can buy out there that follow, your beliefs, that follow your save the whales, that follow green gardening. I mean, there's all kinds of things for you to buy. So you can buy things that are very important to you, and that you want to keep up with and you want to invest in and you want to promote. But you can also, buy something else. But you'd want to research them and see, because if saving the whales was very important and you looked at a company that didn't believe in saving the whales, you might want to know that before you bought into them. So these are just places that you can evaluate your stock. As we looked at, of course, you can Yahoo. There's a thing called Morningstar Value Line. These will all give you ideas of the current prices, like Yahoo does, the current prices, the current trading, what it started at, what it's closing at, its 5-year average, 10-year average, and also any breaking news, etc., that may make a difference in how you invest. There are stock advisory services out there. Some charge a fee. Morningstar charges a fee, I think. Some of it's free. Value Line, I think, charges a fee. And Zacks, I have not used at all, so I can't give you any information on that one. But they may charge a fee. They may have a free one. They may have a free set. They may, if you get over 5 stocks, they may charge. It just depends. But just keep in mind that they can also have materials to help evaluate and look at. The Wall Street Journal was our gold standard, still is considered the gold standard. For researching companies, for knowing about companies. That's the Wall Street Journal's job, is to report on Wall Street. Now, they give other news too, because economic factors, as you know, figure into our calculation of how companies will do. But they're the ones that are the gold standards of keeping up with companies and what they're doing. Stocks have what they call tickers. So, like NVIDIA's ticker was NVDA instead of the whole name. So be sure when you look up a company that you're looking up the right ticker symbol, because there's very similar ones out there. Um, so just keep that in mind. It'll give you the price information, etc. Federal government requires corporations to disclose public information on a prospectus. That is a long written thing. They require it. Now, I will tell you, there's been a few cases they've let somebody hit the market trading floor without all of that. They've also enforced that they have to be making a profit of XYZ, and they have to maintain a profit of XYZ to remain on the trading floor. There's been a couple of exceptions of stocks that have not done that too. So it makes me a little nervous that they're going to change what they've allowed. But based on how this is working, I think they'll eventually have them leave the stock trading market and move to another trading platform. The New York Stock Exchange has very strict rules. Each stock exchange has rules that you have to follow. There's the New York Stock Exchange. There's the Dow. There's regional stock exchanges for like Kansas City has a stock exchange for grain and wheat and things like that. So there's just different ones out there depending on where you're buying. So in past classes, I've had them send stocks that they want to watch. And so I'll pull up a spreadsheet in the next class and show you, but this is what they came up with following Google, following Intel, Apple. Uh, Doge was not a stock, but they wanted to follow that. Seven Brew, of course, it's our local company that's growing hand over fist. Walmart, Tyson, Federal Express, Nvidia, Target, Tesla. Anyway, you can see all those. So that gives us an idea of where we're starting. Um, and then this was another thing that they were looking at, Chick-fil-A. And so these, hopefully hopefully you like all these. And like I said, when I pull up the spreadsheet later, you can see, and what I can do is track them, and you can just kind of see. And of course, the thing to keep in mind too is that, like, if you have $10, some of these stocks are going to be out of your price range, because as you saw with Nvidia, it's already trading at, well over $100. So, you know that would just buy one share. So we'll get into a chapter on mutual funds of how you can maybe get in a little better with that, and do that. Why are corporate earnings important? Well, the same thing with us personally. If they're not showing a gain, if they're not able to pay their bills, if they're not able to meet the monthly demands, um, there could be a problem with the company. So that's the reason you want to look a little deeper than just what's the stock trading at, because sometimes, and again, you can break it down, and there's a factor that'll tell you what the stock is worth and what the stock is trading for. And sometimes riding a bubble of what the stock's trading for is better than what it's worth. The key is, if their financials are not showing really great, but they're trading really high for some reason, you want to be sure that you're okay with not being able to recoup your money, because basically the company has XYZ dollars to pay XYZ payments. If they've got ABC XYZ in stockholders, they're only going to pay XYZ because that's all the money they have. So if you're in the ABC group, you're not going to get paid. So you just want to make sure that there's enough cash to pay out. If the company had to liquidate, it's like your own personal budget. If it had to liquidate, you had to pay everything. Can you pay everything you owe? And stock prices are what they owe. So that's an important part for me. Now, some people don't care about that at all. They don't look at it. They don't. That doesn't phase them. For me, that's a big thing. But I'm a little more of I think I told you, not a high risk taker. So I want to be sure that if they go under, they can still afford to pay me. Earnings per share, that's what they'll have a place on the stock markets when you look at them, what their EPS or earnings per share is. And that just lets you know how many shares are outstanding, how many shares are purchased. And then if that's an increase in earnings per share, is usually a good healthy sign that they've got enough money to cover what they've got. So they're making enough money. Price earnings ratio, there's a PE ratio. If you're in the investment world, I may ask, what's the PE ratio? Has nothing to do with physical education. It has to do with price earnings. And it's a price per share divided by the earnings per share. So if the price is $200 and the earnings are 50, then they've got, 50, 200 divided by 50, and that gives you an idea that they're a healthy company. They can make everything. So looking at this, earnings per share, you look at after-tax income of Procter and Gamble over the number of shares that are outstanding, and that gives you a number. So stock is selling for $148. The corporation's earnings per share are $5.90 per share, and that means their earnings ratio is 25. So both of those calculations and those calculations that we're looking at are based on historical standards. And as we say to everybody when they invest in anything, the past is no prediction of the future. How they've performed in the past doesn't mean that's how they'll perform in the future. Um, so you just want to keep that in mind. Again, like I said, I usually kind of like to look at how they did for 10 years. How have they done? How have they done for maybe 20 years? And then if you have some down years, if you have some years the market fell, um, like COVID would probably be the one most recent for y'all that the market struggled because, businesses were closed and, all that stuff. How did they fare during that? Um, so you just kind of play around with that and look at that. Like I said, most investment sites calculate that earnings per share for you, so you don't have to worry about it. But just so you know how it is, we like to give you a thing. Okay, dividend payout they pay in cash. The dividend yield, they may mention that, is how much the dividend divided by the current price per share gives you, and the total return includes not only the yearly dollar, but also dividends that they're paying. So if they give you a total return, they're including dividends that they're paying plus gains on the stock and anything else. Um, to check out a dividend payout, annual dividend over earnings per share, dividend yield is annual dividend over price per share. So you can see where that difference is on those two things. This is another formula: total return, dividends plus capital gains, total return times. Anyway, another formula. Just so you know, the book's got it. It's there if you want to calculate yourself. Again, most websites that you can look up a stock on have these things calculated for you. But in case you wonder where they get it, this is where they're getting it. So they're looking at dividends and capital gain as their total return. So that kind of lets you know that their gain is greater, whatever. They've included dividends in that. So that lets you know. If you're looking at a volatility of a stock, you're going to look at the increase in the overall market and the beta for a specific stock. The beta looks at the volatility, and what they're doing is they're figuring out how does it perform with a market index. A lot of times they use the S&P 500. Again, the the Dow, the the Dow. I'm trying to think. It's just like 25 stocks. It's grown in the past few years. So the S&P 500 actually gives you 500 stocks over different areas. So that lets you know that you can. That's kind of a greater range. Um, Sorry about that. Slight interruption. We have an outage with our internet and cable, and Cox is in our backyard, and our dog was not real happy with that. Um, anyway, so when they're looking at a price of a stock, other things that can matter um, is the volatility, and there is a calculation for calculating the volatility of a stock. And what they're looking at is, I think I was trying to explain that they're looking at the volatility. So if you're in the Dow, there's just a small group of stocks that make up the Dow compared to the S&P 500, which is 500 stocks. So that index is used a lot for people try to mimic it. People try to use it in retirement plans, and the reason is because it's 500 stocks. So it's stocks from all indexes and all uh, areas of investing, and so its return is not as volatile. Its return is good. And so they always compare how the volatility is doing to something that's a broader spread like that. So that's what they're looking at. So they're looking for the increase in the whole market and then what that beta is for that specific stock. So they look at the S&P 500 has gone up 15%, this stock's gone up 25. So that's what they're looking at, those two things, is to see this stock is more volatile than the S&P 500. Is it going to continue that way? That's the whole thing to figure out. Or is it just a bubble? So, and that's a whole other calculation and thing you don't want to get into. But that's what they're looking at when they're trying to compare how that's performing to something that's performing in the market also. Sometimes they will take, if it's a tech stock, they'll look at a tech beta, and they'll look at the how the techs have done. So how is Apple, and how has Nvidia, and how has um, Starlink, and some of those things. How have they weathered this latest thing, this latest trend? Is it right in line with those? They've both gone up 15%. One's gone up, your stock's gone up 45%, 25%, and that's only gone up 5%, then it's definitely not in that normal bubble. So it's just trying to figure it out. Also, like we have assets minus liabilities equals net worth. That's the same thing for a company. So they're looking at assets minus liabilities equals their net worth. And so you can figure out the net worth of a company. Then, if you want to figure out how much their stock shares are worth, take that assets minus liabilities equals net worth and divide it by the number of shares are outstanding. This is where that comes into. If their net worth is $25,000 and they have 25 shares on the book for $1,000 each, they can cover that based on today's market, based on today's valuation. Now, if they had 2,000 shares at $25 each, they can't cover that. So that's the reason that can come into play, depending on what company it is and depending on if it's a consistent problem. A low price to book ratio may indicate an undervalued stock. A high price to book ratio may be an overvalued stock. What's price to book ratio? Well, that's the price per share divided by the book value per share. So that's looking at, we just did the book value. So looking at that, what's the price? Is it that we had $1,000 a share? If the price is trading at $2,000 a share divided by 1,000, that's that's a that means there's a 2 to 1. So that could mean that that's a higher overvalued stock than an undervalued stock. So that just kind of gives you some idea of what they're looking at when they do those calculations. There are investment theories out the yin yang that you don't have to know or get into for this course. If you're a broker, you have to get into them. I'm sorry. But what they're looking at is, what are the expected earnings of this stock? What's the financial strength of the company? What industry is the company in? Is it in a strong industry, stable industry, fly by night industry? Do they have new product development coming down the pike? What's the overall growth for the overall economy? What does the economy look strong? If the economy looks strong, this group will probably make it. So those are kind of the basic fundamentals they're looking at. There's a technical analysis theory, and that's looking at that the stock market is determined by supply and demand on the stock market as whole. It's not based on expected earnings. It's not based on an intrinsic value of the stock. It's not based on anything except just the technical supply and demand. I would call that an economic theory, because economics, if you had that as supply and demand, but they didn't ask my opinion, so I didn't, get to share that. But anyway, technical analysis is just looking at supply and demand, and a lot of stocks that are out there now are a supply and demand kind of thing. They're not looking at how much the company's worth. They're not doing any research to see what the company's got coming down the pike. They're not doing any of that. They're just looking on, I want that stock. It's going up. I'm going to buy it. So there's an efficient market hypothesis. That means that you're making an assumption that the stock market price is going to move, but the stock market is completely random. Um, but that's also basing it, what the other one does not. The other theory did not base it on what the price is really worth of the stock. This one does take in that factor. So it's looking at what the price of the stock is, and then just thinking that people are buying it randomly. There's no planned uh, format out there for everyone to buy it. They're not saying, "Hey, you need to buy this today." There's none of that going on. It's just this stock is intrinsically good. It's got a good value, and people are buying it at a random kind of price. It's impossible to outperform the average for the stock market, because there's no factors in there. As I said, people try to mimic the S&P 500. If you go in a retirement plan or a mutual fund, a lot of times they'll say, this follows the S&P 500. This is similar to the S&P 500. They can buy all those 500 stocks, which is what they do. But the kicker is, of those 500 stocks that are trading on the stock market, people are buying and selling those all the time. The company that buys that and the investor that's trying to mimic that has to buy and sell the exact same ones at the exact same time to get an exact return that the S&P 500 is getting, if that makes any sense. So if we'll not have 500 stocks in my head, but we'll have 3 stocks, and let's say you have Tyson, Walmart, JB Hunt, and you're following those 3, and you're going to mimic what those gains and losses have been. The thing that you're having to watch, which none of us have the time to do, is who out there is buying and selling JB Hunt, Tyson, and Walmart, which can drive the price up and down. So you may hold those 3 stocks, but you have to buy and sell them at the same rate that the other people in the stock market in the whole world are buying and selling those. So it's very hard to completely um, copy 100% what the S&P 500 is doing, but you can mimic what the S&P 500 is doing. You can own those same stocks, and they'll go up and down at about the same rate that they are in the market. It's just you can't mimic the buying and selling that's going on in the individual. So that's that. Probably a long, hairy explanation for something you really don't care about, but just to give you an idea. Because when you get out, you think, well, I'm in the S&P 500 stock, I should be making that. And they'll say the S&P 500 made 5%, and then you'll get your statement from your employer, and your S&P 500 that you're in, it made only 4%. Well, it's close, but it's not exact, and that's the reason it's not exact. You can buy stocks, what they call in a primary market. That means you're buying them from the company. There's always that option. You may go through an investment bank to do that. They'll sell the securities. You can take part in what they call an IPO. or an initial public offering. Elon Musk Groups just had an IPO, and that they do is they are going to sell stock for the first time. They have it valued. Here's what the stock's worth. Now, in his case, I'm a little leery because they valued his stock really high. Um, but the company financials didn't completely back up that really high price. So I'm really watching that with kind of a skeptical eye to see how it continues to perform, because I feel like the meat of the company is not what the price of the stock was. But people bought into that stock at that initial public offering with the hopes that that was where it started, and it went up exponentially from there. And I hope it does for everyone that invested. And that's your goal. You're buying, if your buddy's got a garage design, he's just, you know, getting ready to market to the world, is going to go public. He'll sometimes let you in on that initial public offering. You're buying the shares, you're giving him cash to work it through. And then when it hits the market, you're a shareholder already. And then hopefully the price goes up from there. So sometimes the IPOs can be very exciting because they hit the market and go straight up, and you can even turn around and sell it that day if you want, if it really goes great. There's a secondary market, and that's financial securities are traded among best investors through brokers. That's what most of us see and are a part of, and et cetera. The SEC, security exchanges, as I was telling you earlier, there's the New York Stock Exchange, there's regional exchanges, and there's foreign exchanges. Those are all where you buy and sell on those markets. And so that's what those are. Over the counter markets, OTC, that's a network of dealers who buy and sell for corporations that aren't on the stock exchange. A lot of times, the OTC ones are maybe smaller regional banks. They're not traded on the stock exchange, but they have stock and they have stockholders. Small companies that have stock, but don't have, I mean, they have stockholders, but they're not traded on the Dow or the S&P 500 or whatever. So it gives you a place to buy those too in the OTC market. So if you're looking for a brokerage firm to work with, first of all, you have to figure, do you want full service or do you want a discount? Full service means they're going to take care of everything. They're going to give you advice. They're going to tell you what to buy, when to buy. You still have the option to say, yes, I want that. No, I don't. But they're basically taking your investments by the hand and saying, I have the knowledge to make the return you told me you want to make with investing in what you've told me makes you comfortable. A discount brokerage firms means you're making all those decisions, but you still have to have a facility to buy them through. And so even if you're buying them online, unless you're buying them direct from the company, you're buying them through probably a discount brokerage firm of some parameter. Now, they're not going to tell you, you need to sell that now. You need to buy this one now. That they don't have that. You could pay for a fee and have that offering, but they're just letting you make that decision and you make those choices. So what should you ask? Well, you want to find out if you can buy or sell them online or over the phone. That's very important and very necessary in today's times. If I buy and sell, are there commissions? And if there are, what are they? Because sometimes a sale can be eaten up by commissions if they charge a commission. Or do they just charge a fee? A lot of times discount brokerages don't charge a commission. They charge a fee of $5 a trade, $10 a trade, or whatever. So that lets you know what that is. But if they're paying a commission to a broker also from that, you want to know what that is. Is it a percentage of my price? Is it a percentage of the sale? Is it a percentage of my purchase price? What are we looking at? How easy is it to use the firm's website, and what services can you use online? That's very important. And most of you that are doing any investing now have probably already waddled through all those decisions, and you're there. So I apologize for the repetition. Is there a phone number for customer assistance? All of us have trouble. All of us have issues. All of us have computer issues. We've just recently had a few on our test. Um, and so if you have those, can you call somebody? And that's always the biggest thing. And do they answer? That's another big question there. Is there a charge for statements? Is there a charge if you want to have research on a company? Sometimes going to a brokerage firm, one of the big perks way back in the day, I'm sorry, way back in the day, was that you could go in and say, give me everything you got on whoever, JB Hunt. And they would give you the history of JB Hunt. They would give you what they started at, when they sold stocks, what their IPO was, um, what it's worth now, who's running the company, how decisions are made, when do they do, what are they looking at down the road, can they go to intermodal, intramodal, what are, all those things. And you could get a ream of research that you didn't have to do. Well, question, do they charge you for that? Sometimes they do, sometimes if they don't. So you just want to see where you fall in that. If you need to get a statement, is there a charge for that? Or can you just download it online? Do they automatically generate them? And then any other financial reports that you might need to have, because those are assets of your account. It's your investment, whether it's your retirement plan or whether it's your IRA or whether it's your personal side fund. You're going to have to put that information on a balance sheet, and you're going to have to show that information when you want to get a loan. You're going to show that information when you want to prove what your assets really are, and so you need a statement. You need something from them that shows that's what you owe and own. So that's what you want to do. And then, are there any other fees? Sometimes there's hidden fees. When we get into mutual funds, we'll get into what the fees are disclosed and et cetera. But just make sure that there's not anything hidden in there, that if they have a quarterly fee they charge no matter what, they have whether you've traded or not, that kind of thing can eat up an account pretty quickly too. You can have an account executive or a stockbroker. They're licensed to buy and sell. They usually have extensive knowledge of the market, of things that are out there. They're the ones reading those reams of things, studying those reams of things so that they can give you good advice on what you want. Um, Generally, account executives are not liable for client losses that result from their recommendations. So that's a CYA moment or CYB, cover your bohonkas. Um, so you want to be sure. I mean, they'll tell you what to buy, but if you lose it, if it was a bad advice, that usually there's no recourse for that. So you want to be sure about that too. These are just the brokerage houses that you hear about: Robinhood, Fidelity, E-Trade, Webull. That was one I hadn't heard of. But anyway, and then it tells you what their advantages are over here on the far right, and then also what the ratings are. And Nerd Wallet is a I consider to be a good company that I go to for financial information. So it tells you that Fidelity is a 5 out of 5, Interactive Brokers is a 5 out of 5, Webull is a 5 out of 5, but the rest are 4 point something out of 5. So they're all good ratings. Of course, commissions, you want to be sure about those. Sometimes they have an introductory free offer, but they may have other restrictions. So just know your stuff and read everything. Of course, that's the big lesson of today. When you want to buy or sell, well, you can put in what they call a market order. And that means you're just going to buy it at what is trading at today. So like on the Nvidia, while we were watching it dropped. So if we put in the market order when it was a little higher, it dropped right after we put in the market order. So that's just whatever they can get your order in for, or whatever you can get your order in for, is what you buy it at. Limit order, and I put a market there so you could see what a market was. And think of it like if you go to the farmer's market. You're going to go buy raspberries or grapes, whatever those are, tomatoes. You're going to buy them at the price they are. So that's exactly the same kind of thing with a market order. A limit order means I want to buy or sell it at a specific price or better. So that gives you a little bargaining room. So you can say, I want to buy, Tyson when it's at $50 a share or less. So if it's trading at 52, it's not going to buy today. If it trades to 51, it's not going to buy today. If it drops to 50, your order goes in. If you want to be less than 50, you have to have that specific in there. You can also have it sell at the same thing. If you're getting close to where you're following the rules of class, and if it hits double, you're going to sell the one chunk that's doubled. So if you bought it at 100, you're going to sell it at 200. You can say, I want to sell 100 shares when it hits $200 or more. And so then that way you know for sure you've got that locked in there. Or you can have what they call a stop loss in there, and it just says that it will sell it at that exact price, not 200 or better, just 200. So if it goes to 201, it's not going to sell. If it goes to 200 with a stop loss, if it goes to 200, it's going to sell. And so you hope, of course, that's the case. But if you just have it locked in your head what you're going to do, so that just gives you an idea of how you can do that. So it gives you a limit there that you can say, this is where I want to buy it, this is where I want to sell it, or you can just put in an order, buy it at whatever it's trading at when they get the paperwork done. course, there are techniques and investment strategies. One of them is the buy and hold, which we've talked about. Just hold it regardless whether it goes up or down. That's a tough one. It's not a tough one if it's going up, and it's not a tough one if it drops a little. If the market starts taking a real downturn, that's the toughest thing to hold on to because you're sitting there going, okay, my stock was worth 50, now it's worth 40, and it's still going down. And so it's really hard not to just jump in and sell, which is why if we have a downturn in the market and it starts dropping and then sometimes it'll just plummet. Well, that's because all those people sit there going, okay, it's going down. And then when it hits that, they go, I'm out. I mean, I can't do that. I can't, I'm out. And then there's always a bunch, uh, with the orders that we just saw earlier, brokerage firms around the country have a bunch to sell. If it gets to 40, sell it. If it gets to 39, sell it. So that drives some of that price down. But then all the individual people that are holding it look at it and in their head they're going, I can't do this, I got to get out, and then they dump it. So there's some big stage dumps in there that can drive a market down without it really being a down market day. So it's a little frustrating at times trying to keep up with it all. There's a dollar cost averaging technique where you buy an amount every so often, regardless of the price. So you're just trying to look at, I'm going to buy some today, and I'll buy some in a month, and I'll buy some in another month. Kind of like when you put in money into savings if you have it taken out of your paycheck. And then so what you're doing is instead of buying every share at 25, you're buying a share at 25. Next month it may be at 24.99, and the next month it may be at 20. And then those three added together are going to give you your price per share that you've had because it's an average. So, um, there's the direct investment and dividend reinvestment plan where you buy directly from the company and then you have those dividends by stocks and they're not paid to you. I was gifted when I graduated quite a long time ago. I was gifted stock by one of the investment professors here at the university, and that's what he did for his kids. And he was wonderful. He thought of me as a child, but anyway, one of his kids. I was very honored. But anyway, he gave me a gift of stock, and I didn't. It wasn't a stock I would have bought. It was a great stock. It was one of those blue chip companies, been around forever, et cetera. And it paid regular dividends. And at first, I started taking the dividends out, and I thought, no, I think I'm going to keep this stock long term. It was a gift. I have nothing invested in it, so I kind of wanted to ride it out for the long term. So I eventually set up to have the dividends reinvested. And granted, when the stock's selling $100 a share and they give a $2 dividend, you're not getting a whole lot there, but they would buy a percentage of a share. And so eventually, with that happening, I had more shares in the company, and I still had to report the dividends as income, but I wasn't taking the cash. I was just putting it back in the company, which works well for the company, and then worked well for me to have extra shares. Short-term investment strategies. I don't know if all of y'all have heard of the day traders. Um, you're probably too young, but well, not all of you are too young. Um, but there was a big fad a while back that everyone quit their. Well, there was how things spread in social media. There was a group of people that probably were pretty investment savvy, individuals around the country that quit their jobs and began day trading. When the market became a little more volatile and less structured and you could buy stocks yourself, you didn't have to go through a brokerage house. All these things were shifting in how we could do stuff. And so the market was much more accessible. And so they would sit there and they would, sleep during the day, basically a lot of them, and then be up all night watching foreign markets, figuring out what foreign markets were doing, how they were going to affect our markets, and then by the opening of trading, they had figured out a handful of stocks that they thought were going to open low, and in one day make a chunk of money and sell high. Now there were a handful of those people that did that made a bucket load of money. And because they did in an all true fashion, with social media, the TikTok challenge of the day became everybody quit their job and everybody go to day trading. Well, as this happens, not everybody was successful at it. There were a lot of people that lost their shirts, they lost their homes, they lost their cars, they lost everything because they were not good at it. But like I said, and they literally were buying the deal of the day, buying it low, selling it high, and making a profit, which is great when it works. So It was real, and there are still some successful day traders out there. There are still some that did, but it is a full time research, full time watch, and full time gamble to see because our market is very unpredictable, as I've said repeatedly. So trying to find the hot item of the day and how it's going to project can be kind of a hard thing to figure out. You also can do what they call buy stocks on margin, which means you borrow the money. Your ultimate goal is to, like, say I want to buy $5,000 of this stock, and I'm technically getting a loan to buy that 5,000. My goal is that that stock will become $10,000, my investment. I can pay off the loan and I have $5,000 profit. Again, in theory, that works great. And there's a lot of people that buy stocks on margin that are successful. There's a lot of people that buy stocks on margin who aren't. The problem is you still owe that $5,000. It's like getting a loan at the bank or doing anything. If you say, I'm going to buy those $5,000 worth of shares, they're yours, period, whether you've paid cash for them or not. If the price goes down, you've got to pay $5,000 and you can't sell those shares to make that $5,000. So you gotta be sure about that in my book before you do that. You can also sell short, which is the same theory as borrowing on margin, borrowing money to do it. This one though, you're borrowing stock. So let's say you've got a broker, or you can do it without having a broker, but it's easier for me to understand with a broker. You've got a broker who says, "Yeah, Mrs. So and so's got 500 shares of that stock. You could have 100 of them." So you're borrowing her stock. You're going to make your money, you hope, and then you're going to repay her stock because of course you have to put that back in her portfolio. Um, and so you're buying a stock, you think it's going to triple or double, and so you can sell it back and then put those shares back in it because you're returning the shares, you're keeping the profit basically. Again, you owe that account those stocks. So if the stocks go south, they don't go like you think they're going to go, you still have to replace those stocks at whatever price they're trading at. So, that's just something to keep in mind too. And then there's buying or selling, buy it at 60, buy it at 50, sell it at 60. And that's how you say, that's what I'm going to do. Buy it at 50, sell it at 100. Um, and that's what you're expecting it to do. That's what you call trading in options. That's a predetermined price. So it's setting the price that you want to buy it at, setting the price you want to sell, and then, of course, hoping it works out that way. And there is a little video here. And we don't have internet because Cox is here working. So you can watch this on your own. It's a nice little summarized video that'll tell you about stocks and kind of go over what we just covered in a very clean, concise, less rambling way than I do. And so I would recommend that you watch that for sure. Okay, if you have any questions, of course, let me know. And thank you for your time.